Welcome to Alternative Investments Chat,
where we demystify the world of alternative investments and financing for entrepreneurs and investors alike.
With these discussions, we hope you're more empowered to unlock opportunities in your business or portfolio. I'm Erin.
And I'm Erica. Let's get started. Hello, and welcome back to another episode of Alternative Investments Chat podcast. So the year of 2025 is coming to a close.
Yeah, it is.
Believe it or
Somehow.
not. I know, I can't believe it already. I feel like we just hit January 2025. So we thought this would be an amazing time for us to kind of chat about the trends that are on the horizon for alternative investments in the upcoming economy of 2026.
Yeah, exactly. We're talking about the trends that insiders, institutions, and major analysts are already gearing up for. But we're breaking it down so it makes sense to even those of you who might be brand new to investing, baby investors.
Just like us. So let's be honest here. The future of alternatives is huge, complicated, and kind of a nice wild ride, if you ask me. But once you get the themes down, I think it's actually really exciting.
Yeah,
so
exactly. Let's get into it. It should be no surprise when I say that private markets are going berserk. It's happening right now, and it's only expected to continue more in 2026. Private markets have been widely regarded as difficult to navigate and even more difficult to access in the past. Not to mention the transparency was leaving much to be desired.
Yeah.
But private markets are actually evolving. And we've touched on this a bit in previous episodes, but this is good news.
Yeah.
Major moves have been made to make private market investments more accessible and transparent. In the past, you basically had to be a major institution to even get in the door. Now, opportunities are available to high net worth investors and even increase access to include these kinds of investments into retirement planning.
Which we did an episode on, everybody. So
We
make sure
did.
you go
Check it
find that
out.
one.
Don't get me wrong. You still got to be, rolling in the dough for this to work out for you. But it still shows huge growth in the sector.
You're absolutely right. And I want to highlight some key predictions from BlackRock's 2026 private market outlook. So a lot of these huge firms, they do these outlook reports. Yeah, I was going to say surveys, reports. So we're going to kind of talk about a few of those within this episode. So if you hear the word outlook, we're not talking about your mailbox. We're talking about those reports that these companies do.
Yep.
So for private credit, BlackRock predicts that credit markets should continue to grow. Again, we said that's great news. So they note that periods of high volatility push borrowers to private credit over public market debts like banks, which is great. So in particular, BlackRock states that they predict asset-based finance to expand in 2026.
Yeah.
We talked about asset-based. So just as a quick little refresher, asset-based finance is a really, really important piece of private credit puzzle. Okay. We talk about this. You want some stuff, but the borrower gets financing in part by offering a tangible or intangible asset up for collateral. I know that sounds weird because it says tangible and intangible, but
yeah. Intangible would be like music royalties.
Exactly.
And tangible would be like a building.
Exactly. So they both, but you can sell them off. So that's what they want. They want to make sure that you've got something that if something goes sideways, they can sell off quickly. So this means, again, they want to be able to recoup their money. What's cool about these asset-based finance is that a borrower doesn't have to rely solely on their credit or profits in order to get the money they need. Okay, so ABF, as these asset-based are often called, is responsible for the construction of buildings, expansion of delivery routes, and even medical equipment innovation.
Yeah.
So what does that mean for investors?
Yep.
Okay. BlackRock says that they could be actually a fantastic way to chase down the illiquidity premium, which we've also talked about. Plus, investors might feel more protected with this investment since there is a way to recoup some of their funds if they lose them.
Yeah.
Again, they can sell those off to make some of that money back.
Exactly.
Right? So
And
those are great.
It is, yes. It can definitely be a perk. We should also mention that companies are actually staying private for longer. This contributes to the need for companies to get creative with financing, which means this may be through ABF or other forms of private credit. But that also means that investors are facing a liquidity problem. Investing in a private company is not like investing in a public company. Unless the company goes public or there's another major event that happens, like an acquisition, your money is tied up.
Yeah.
It's stuck there. But investors are getting creative. They aren't just sitting back with their hands tied.
Yeah.
Would you ever think that would happen? No.
No.
Investors are like, they're gonna figure out a way.
Yep.
So the solution is the secondaries market. This is where investors can sell their stakes to another private investor if they need or want. This is once seen as a niche tool, but the secondaries market is being used by GPs, LPs, general partners, limited partners, both for the liquidity and the flexibility that it can offer. But that's not all. Beep, beep, it's the continuation vehicle coming through. This nifty little ride allows for a GP to transfer one or more portfolio companies into a new vehicle so that existing investors can either cash out or they can reinvest and roll over, giving managers more time to grow the asset's value. This structure allows for current LPs to exit if they're like, I'm done with this, I want to get out of this, I want to liquidate. And it gives new LPs an opportunity to hop on an investment that they might have missed the first go round, or get in on an investment that now has some numbers to back up how it's doing. And, hopefully it's doing well, and they see the writing on the wall that, oh, this will be a good potential investment for me.
Or they might have some FOMO, which we've talked about as well.
Exactly.
You know?
They're like, I got to get in now.
I got to get in now. If I don't, the new vehicle's going away. But so now, did you think that we could talk about the trends of 2026 and not mention AI, guys? Come on now.
Exactly.
AI is everywhere you look. Everywhere. Every commercial that's on the radio, or I guess the streaming services that I listen to. So that'd be like leaving Beyonce out of the lineup of the greatest pop singers of all time.
Yeah.
Okay.
Can't do it.
You can't. AI, she here.
She
here. She ready to belt it out, right?
Yep.
Now, what do we know about AI? The computer processing power doesn't just come from nowhere, right?
Yeah, it doesn't fall from the sky.
No, someone had to invent it. So huge data centers, chips, and all sorts of other tech equipment is actually required for your bot to tell you how to write an email to your boss, which actually is the number one reason. I don't remember what survey it came from. Sorry from whoever I'm citing that I'm not giving you credit for this, but there was something that said that that's the number one reason ChatGPT is used, which makes me laugh. So it's no surprise that alongside BlackRock, JP Morgan, and in their 2026 outlook, again, they're surveyed, their report, not their mail, predicts that AI infrastructure investments to expand with impacts extending to both private and to those public markets.
Yep.
But there are a lot of unknowns about AI to be mindful of, okay? And JP Morgan actually says, while we know that AI is here to stay, that doesn't mean that it will be steady ride up for to those returns. You know what I mean? Material shortages, regulations, or rising costs of AI are all factors here that could cause stalls or dips in this sector.
Yeah, exactly. For investors and institutions alike, the impact of AI is immense. It can't be ignored. In Deloitte's 2026 outlook, they note that firms are increasingly looking for talent with AI expertise.
Yep.
What does that mean? Well, big firms like Morgan Stanley, Vanguard, Goldman Sachs, they're looking for people who know how to leverage AI to make reporting easier and enhance customer experience. For these firms and its employees, this means less manual labor and more brain power that is spent on other things as opposed to the tedious tasks that nobody really wants to do. For example, Morgan Stanley recently launched their OpenAI-powered platform called Debrief. It's kind of like Fathom, but for wealth advisors. It summarizes key points from a meeting, creates follow-up emails, and automatically saves its notes into Salesforce for you. These are all important tasks, right? They're things that need to be done so that we can keep up with the, obligations of our jobs, stay organized.
Yeah.
But I think we can all agree that they're super time-consuming, and sometimes with a busy day, very difficult to keep up with and make sure that you're getting to it.
Yeah. Well, I love, oftentimes when we have meetings, it always says so-and-so's Fathom notes are in the meeting. And I appreciate whoever put their Fathom in there. We get that little report at the end, and I can quickly just search through it real fast and make sure I didn't miss anything. Even though you're in the meeting, sometimes I don't hear stuff.
Right.
You know, you want to talk about busy day. I'm thinking about what I'm going to eat for lunch, or depending on what time the meeting is, what I'm going to eat for dinner. Oh,
Sure.
shoot, I need to change my laundry over. Oh, we have this here.
Yep.
So things get missed. So these kinds of, I think Debrief and Fathom are great tools, especially for the AIs, because somebody didn't have to sit there and take the minutes like they used to. So how many times have we all wished for an assistant to help with those kinds of tasks? Just like that, those Fathoms. So now you have one in your back pocket, and I love that. And I will take Fathom with me wherever I can go. If I could have Fathom write my notes that when my mom talks, that would probably be the best one. You know, I miss a lot of stuff that she says, but that's a whole nother. So, but investors love this too, right? So if you listen to a show, you know we always suggest using a financial advisor for your professional advice.
Yep.
We are not professional advice.
Yep.
And we're going to keep saying that, and that's going to reign true for as long as this podcast exists. We are not financial advisors. Please use one. But AI can be a super helpful tool to work in tandem with your advisor to help you get some of the most of your portfolio.
Yeah.
AI can help investors pick stocks that best fit their portfolio. Human financial professionals can help do this too. Obviously, that's kind of what they get paid for. But AI can actually provide insights and suggestions and analyze information much faster than human beings are capable of. I mean,
Like this,
exactly.
as opposed to what would take an advisor, you know, maybe a few hours to do.
Yeah, they're really smart. They're really, you know, if you get a really great one, they understand their market. They understand you. They have that fiduciary responsibility to you to ensure that they're picking the best things for you. But that could be combing through some stuff where AI can really just pick it up. So again, I'm not saying to take the bot's advice and just like run with it and be like, this is what it said and this is what I'm going to do. But it can be very helpful to highlight some interesting options for you to investigate further or to give to your advisor to investigate for you.
Exactly.
AI can also help balance those portfolios we've talked about a little bit on this podcast, but using historical data, market trends, and personal information, AI can help optimize your portfolio.
Yeah. Make it work for you.
Exactly. It can help customize your investments for you, kind of like look at gaps where it might be able to fill something in, say, hey, you know, you've got way too much of this. Like, have you ever thought about farmland?
Yeah, there's a little bit of risk here. Maybe we can mitigate that risk by diversifying here, that kind of thing.
Exactly. Again, grain of salt with all of these, but it's a very cool tool to use in combination with your research, your advisor and research methods that you do on your own. So in my opinion, of course, just my humble opinion, AI is here to stay.
Yep.
And it might be best to jump on that bandwagon quicker and get yourself familiar with it.
Yeah.
Because she ain't going nowhere. So keep your guard up, however, and maybe just like dip your little toesy in there and into that AI world. Put that big toe in there and see what, test the waters.
Exactly. Okay, so we're going to kind of switch gears here. This is something that I'm excited to talk about because it actually kind of takes everything that we know about capitalism and flips it on its head.
Oh, I like it. Let's talk.
We know that typically the place where companies choose to either manufacture or have labor outsourced is wherever it's cheaper, right?
Yep.
This is why we do that is to increase our profits. In other places where building a factory might be cheaper, the labor might be cheaper, you're able to get more money on your end, right?
Right. And
globalization and free trade agreements have largely allowed that to happen pretty easily over the past couple of decades. But JP Morgan posits that might actually be changing. Think fragmentation over globalization. They call this the reconfigured economy, which sounds pretty sci-fi if you ask me. Yeah. But let's actually get into what they mean by that. Okay. First, JP Morgan points out that there are distinct trade blocks that are being established, meaning different regions are creating their own trade policies that benefit themselves rather than everybody having to follow a certain set of rules or regulations that may better benefit the global trade market as a whole.
So exactly. And we have some examples for this in real time.
Yeah.
Well, we always like to give those real time examples. So tensions between Japan and China are still unresolved.
Yep.
This is nothing new here. In fact, this conflict has been tracked back all the way to 1931.
Yeah.
So, okay, we already know this exists, right? The beef.
The beef.
I don't know if it's about beef, but you know what I mean. Most recently, the countries are in what you might call a love triangle with Taiwan.
Yeah.
To put it lightly, that just, the three of them are
they're fighting.
They're
fighting over Taiwan.
Over
really.
Taiwan, yeah. Oh, it reminds me of like grade school when two little girls like one little boy, and he doesn't want to be mean to either of them, right? So without getting too deep into the weeds, China has goals to unify Taiwan with the mainland, and Japan doesn't want that.
Yeah.
They're like, no, don't come to my party, not her party. This conflict has wounded Japan and China's trade relationship, to say the least.
Yeah.
And both countries have been retaliating against one another in a trade and travel restrictions.
Yes.
Oh, fine. If you're not going to come to my party, then, right?
Yep.
So another example we know about is the tariffs rolled out by President Trump. Okay, these tariffs impact various countries such as China, Canada, and Mexico. Now, the Trump administration is certainly not the first to enact tariffs, but we are pointing this out simply because it shows how recent regulations are impacting trade relationships globally.
Right.
And the U.S. actually isn't the only one actually imposing these tariffs.
Yeah.
So in October of 2024, just last year, Canada, as I like to call it, Canada imposed a whopping 100% tariffs on electric vehicles and 25% tariffs on steel and aluminum from China.
Yeah.
Okay. So China recently hit back with their own tariffs against Canada in July. So we can just keep going, but I think you guys get the picture here. Like, this isn't just a President Trump thing. This is a country by country. Everybody wants to charge somebody else and make more money, right?
Yep, exactly. Consider me enlightened. Honestly, all of these retaliatory actions really feel like a food fight. It's like someone throws their sandwich and they hit the person they meant to hit, but it also, in the crossfire, the lettuce goes and somebody gets hit by the lettuce. Well, then that person picks up their spaghetti and meatballs, and then that starts to go. And then all of a sudden, you have every single person in the cafeteria throwing food. We don't really know who started it. We don't really know who you're even aiming for.
Yeah.
You're just trying to hit something. So, that's kind of what it reminds me of. Obviously, I know that there's a lot of nuance to these things. There are years and years and years, decades of relationships and tensions that have been walked back and then walked forward. I get that, but that's just kind of my funny analogy.
I like it.
Think about.
Did you ever get to participate in a food fight?
No.
I think it was only in movies.
Yeah,
I've never actually seen.
I don't want to.
Oh, no. If I get something in my hair.
Yeah. And then you have to go back to class. Yeah.
Yeah.
It's not for me.
Stained, gross.
Exactly.
No, thank you.
But what does this all mean? Well, it could mean high volatility in trade and supply shortages. We've seen some trickling effects of this happening already. So instead of asking the question of who could make this the cheapest, which is what we've always been asking, the new question is now, who could make this securely and reliably? And that changes where opportunities are. For example, defense, energy, infrastructure, and commodities are becoming these massive alternative investment themes. So, be on the lookout for that.
You're right. And that actually mirrors the trend that we're seeing for demand in asset-backed investments. Now, we've finally got that, we've talked about the elephant in the room, finally got that out of there because AI. Perhaps one of the biggest concerns for Americans right now is inflation. Okay, that dirty word. In an inflated economy, you aren't getting the real value for your money. Your dollar isn't stretching as far as it used to.
Yeah.
We don't like to see this. So inflation not only affects your daily lives when you grocery shop, but also our investment portfolios, and it can actually eat away at those returns. I like to think of it, the boomers, if you're listening, back in my day.
Yeah, exactly.
That's what I think about when I hear
get a
inflation.
cup of coffee for a quarter.
Quarter, I now pay 9 and change.
Yeah,
That's
exactly.
$1 tip in there for the record, but it's still $8 for the latte that I get from my favorite place, Starbucks.
Exactly. And inflation, it's kind of like Voldemort right now.
You and your
he who shall not be named. Yeah, it's Harry Potter season right now. It's Christmas time. But
I thought that was like a Halloween movie. I
No,
don't.
Harry Potter's
Listeners,
Christmas.
sorry, come and get me if you'd like, but I'm not. I have no Harry Potter knowledge, and I apologize.
It's good. Worth watching. I watch it about like once a year. Anywho's, but like Voldemort, it's better to talk about the scary things and plan against them instead of just ignoring them and hoping they go away. So here
Like
we
most
are.
Americans do.
Like whatever. In an article from Reuters, this was released at the end of November 2025, so like a week ago. Predictions pooled from 42 different professional forecasters were shared, and here are some stats. The median outlook for next year's growth is 2%. People are still spending and investing, even with inflation happening, meaning that growth is still happening.
Okay.
A GDP of 2 to 3% is what we're typically aiming for. We would like to be more in like the 2.5, but 2% is not bad.
Okay.
And for inflation, they're predicting a rate of 2.6%. For reference, the target rate for inflation is 2%. So now these predictions are just predictions.
Yeah.
And averages at that, right? So there are many different opinions on what inflation and growth will look like next year. So we won't really know what will happen until it happens, right? We don't have that crystal ball, but this is, 42 different people. This is kind of what they're thinking.
I wish we had that ball, but so all in all, these numbers are looking all right.
Yeah.
They're okay. But what's interesting is that consumer sentiment actually doesn't match these numbers. So I think we're still very, very much traumatized from the rates that we saw with the aftermath of COVID.
Yeah.
So in 2021, the average inflation rate was 7%. That's a lot higher than that 2%,
It
right?
is.
The next year after that was 6.5. Then in 2023, it was 3.4. And 2024 was 2.9. So gradually those rates have been coming down, but it seems like we don't quite trust it yet.
Yeah.
So a survey from the Conference Board for their Consumer Confidence Index reports that at the end of November, consumers were averaging 12-month inflation expectations come at 4.8%.
Yeah.
Still
So like
higher-
double
double
what
than that
the
too.
professional forecasters are expecting.
Yeah. So, well, now I don't know about you, but I have my fingers crossed. These fingers,
And
my
your
toes
toes?
crossed.
Yeah.
That the consumer predictions are incorrect.
Me too. I definitely don't want that to be correct either.
No, I can't pay more for my cup of coffee.
Yeah. But let's wrap up on a high note. Here is a mic drop stat. Experts estimate that the global alternatives market could reach $32 trillion by 2030. Now, I know this isn't next year,
Yeah.
but it's not that far away.
No, it's not.
This stat is coming from the Private Markets in 2030 report from Preqin. This is a company that was actually acquired by BlackRock in March of 2025. This growth is fueled by basically everything we have mentioned today: AI expansion, private credit scaling, infrastructure demand, geopolitical shifts, inflation hedging, and more investors are entering alternatives. Preqin expects to see a 60% increase in the total assets under management in alternatives in the next 5 years.
Hey, it's not too far away.
It's not far away, but a 60% growth. I'd love to see my bank account
Grow
grow by
60%?
60% in the next
Me
5
too.
years. They expect this growth to be powered largely by wealthy investors who are incorporating more alts into their portfolios. So these are like the people that have millions and millions of dollars who are going to be really contributing a lot more money to this space. But that means more growth, which is pretty interesting.
And hopefully those people are learning about these categories, listening to us talk about all of them. So anyway, that's your, I have high hopes for ourselves. So that's your sneak peek of 2026. Might look like for alternative investments and beyond, infinity and beyond, right? Again, if you are new to this space, please don't panic.
Yep.
You don't need to understand everything today or right away or anything like that. In fact, a lot of this information, again, we've learned by doing this, by doing some research, and we know that our listeners can do that. And remember, this podcast is not investment advice. We're going to say that once again, but instead a place for us to learn together.
Yeah, exactly. Well, thank you so much for hanging out with us. Again, we hope you learned something new. We'll catch you on the next episode. And don't forget to subscribe so you never miss an episode with us. We'll see you next time.
Thanks for joining us. Stay tuned for more insight on our next episode.
And don't forget to subscribe to continue the Alternative Investments chat.
See you next time.
Content provided in this podcast is for informational purposes only and should not be construed as professional, financial, or investment advice. This podcast should not be construed as an offer to sell or a solicitation of any offer to buy any securities. We strongly recommend that you seek advice from a qualified professional before making any financial decisions.